Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning to uncomplicate the issues that we have with our financial, investment, and retirement planning. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. And Chris, I hope all is well in the world at the McIntire household.
Yeah, it sure is. It's busy as ever. You know, but between business and some aging parents and, the like, there's never a dull moment, buddy. And that's probably the understatement of the year.
Yeah, indeed. At the Rashawn household as well. And Chris, I imagine you, like me, like probably all of the listeners, are getting those tax forms in the mail, getting ready to put everything together. Maybe we file ourselves, maybe we cram everything in the shoebox, hopefully slightly organized for the benefit of the accountant or tax preparer, but getting ready to reconcile that bill from last year and trying to figure out, do we get a little back? Do we have to pay a little? And I think most people have a preference there on what they would rather do, but end all be all, we've got to come to terms with the IRS once annually, and we are in that season.
Yes, and it's going to be a busy season, and it's not as busy in our office on tax season as it is required minimum distribution. For us, we've already done the tax planning. For the folks listening to the show today, now they have to do their taxes and the ramifications of things that they did last year, bonuses that got paid, overtime, just in your normal wages, IRA distributions, Roth conversions, capital gains taxes, even capital losses. Last year, we did a lot of selling and locked in losses for clients because obviously stocks and bonds were both down for the year. And that's only relative outside of IRA accounts. So you cannot have a capital loss inside an IRA. It has to be outside of an IRA to be able to take that loss. And, a lot of people ask me about that one. That's one of the most popular questions we get is, can I take a loss on that? I said, well, you haven't paid any tax on any of the money. How do you take a loss on it? So, our biggest request that we get from lots of clients is, when is my 1099 ready? And for everybody listening to the show today, look, they get sent to you in the mail. We don't create them. Oftentimes it's, mid to late February before 1099s go out. And Peter, I always tell folks, if you have non-IRA assets and you did some trading last year, I would probably wait until late March, early April to go in and see the accountant, because it's very common to get a corrected 1099, and that's the one you want to submit to the IRS. So yeah, it's nice to get it done before you head south for the month of March or whatever you want to do. But sometimes it's better to be a little more patient and do your taxes closer to the deadline, or even an extension if you have to make sure when you file, you do it right the first time.
Yeah, absolutely. But a lot of different complexities, a lot of different situational and very specific implications with taxes and planning and financial moves and investments. And you want to make sure that all of that documentation has been received, that you've got everything appropriate before you file, because we don't want to have to correct and refile. And so sometimes we want to get a jump on that, and I certainly understand it, but also sometimes a little patience is prudent there. But ladies and gentlemen, bottom line is last year is last year. It's so in the past, has already happened. There are only a very few select limited opportunities to do anything about last year, but planning and looking at the year and the years ahead, wow, lots of opportunities to control our taxes moving forward. And that's what a proactive approach is really all about. And oftentimes when we see the plan in place, the written retirement income plan, including a forward-looking tax perspective, it can mean the difference in several hundreds of thousands of dollars to think proactively about taxes, which is why Chris McIntire is here reminding us of the importance of this and detailing a few of those strategies each and every week on your game plan for retirement. If you would like to look at your plan, if you'd like a free, no cost game plan for retirement, written plan put together, pick up the phone and give Chris a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, you hit on it, and I do think it is a big question about, well, what about the gains and losses within my IRA or Roth account? There's a big difference between retirement qualified investment and non-qualified investment. And those two things need to be handled very differently. Just a regular vanilla investment or brokerage account, or even the interest from our bank is going to be very different than what happens with the growth or the transactions that occur inside of retirement accounts.
Oh, yeah, no question about it. So, let's keep it real simple here. Let's say you had $100,000 in a bond or a CD, certificate of deposit, that paid 4% interest last year. And it was just regular money that you had extra sitting in a checking account. You stroked a check to the bank, $100,000, made 4% interest, $4,000. That interest, if it's a regular corporate bond or a regular CD, is going to, you're going to get a 1099 for $4,000 of tax. That will be taxed at the income tax rate, not the capital gains tax rate. So if you're in the 22% income tax bracket with that $4,000, right, you get 4% minus 22% of that, So I usually do an analogy. If you made 4% and you paid an effective tax rate of 20%, you netted 3.2. So sometimes tax deferral, like using a fixed annuity, it could be more beneficial than a certificate of deposit, depending on what you want to utilize the money for. And, so we're doing a lot of both of those. If it is inside your IRA or a qualified account, as Peter said, or a 401k, which is also qualified, or a Roth IRA or a Roth 401k, you can trade all day long. As long as you didn't take any money out, you don't have to pay any taxes on that.
The only tax documentation or taxable event is going to be when money goes in or money comes out of those accounts. Any sales or purchases or shifts in allocation inside of your 401k or IRA, so long as it remains underneath that qualified tax deferred shelter, those are not going to be taxable events. And you can even move it from account to account, from a maybe different institution. For instance, I know 401k rollovers, Chris, are very common, from your 401k to an IRA. And that even will not be a taxable event. I know a lot of people do have questions. Well, if I roll out my 401k to begin really planning for retirement, aren't I going to have to pay tax? And if done properly, the answer is no.
Yeah, that is correct. When it comes to distributions from IRAs, the only tax bill you get is when that check goes into your checking account, for example. On those non-IRAs, those things can spin off a lot of taxes, dividends that get paid out. So, this can be a confusing and a cumbersome subject, and we're trying to break it down to be simple for everybody here. But
it's not simple.
No,
Bottom
it isn't.
line.
Yeah, you're right. Because you might have a non-IRA brokerage account. You didn't take any money out of it, but you still got a 1099 for dividends, maybe interest and things like that. And you're like, look, I didn't spend any of that. And it's like, that's just can be part of non-IRA type investing, is you're going to have some sort of taxation issues along the way. And you can be very efficient between what type of investment vehicles. how much trading you do, taking capital losses to offset capital gains. And unfortunately, sometimes in the industry that I find myself in, I see it on the other side where there is, I'll call it a lackluster amount of effort put forward to service the non-IRA type of clients.
Well, Chris, and we, for that reason, need to be very careful about what types of accounts we are choosing when placing our investments, and in retirement when removing money for income from our investments. There's sort of a optimal order of operations, or at least with each piece of income we take, probably a best place to take it from, which sometimes takes some careful analysis. And you mentioned creating that income in retirement. It's not what we make, it's not what we have, it's what we get to keep out of it. And often planning strategically to be tax efficient is as effective as shooting for higher returns on our money, but with far less risk involved.
Yeah, there you go. Yeah, that word efficiency is very important in this entire equation here, from investments to taxation planning, all of those aspects, Peter. And you talk about the order of operations, and taxes are one of four things that we do with our income. While we work, usually paying taxes is the first in line, and it's done automatically.
That's right.
We're self-employed, so we do it manually. But for those of you that work for companies where you get your income, on paid every 2 weeks or something, they take the taxes out for you, and typically you can tell them how much to take out, how many dependents, how you file your taxes, so on and so forth. And then you pay your bills. Okay, then you do some spending, things you might need, things do some traveling. And then, if there's some money left over, maybe that's what you do in your investment side of things. So, if you look at, when people bring in a pay stub to me, we take a look at, it's like, okay, here's what they took out for Social Security. Here's what they took out for Medicare. Here's the federal government, the state government, maybe the local, city of Toledo, city of Sandusky, whatever it is. And then here was your 401k contribution, and here's what you got to take home. And, not many people look at it often because it becomes automatic, but they realize, boy, the government does play a significant role in your life. And they typically do, and for most of us listening to the show today, it's the outgoing, not the incoming, that they help us, that they hit us with.
Yeah, well, tax is one of our largest expenses over our lifetime. I know my annual tax bill certainly rivals and surpasses my mortgage payment. So we've got to be efficient and plan effectively where possible. And again, ladies and gentlemen, if you would like to identify the strategies and then execute planning that helps you be more effective and tax efficient, that is part of the no cost, no obligation game plan for retirement that Chris McIntire will put together with listeners to this program, and then continue to review and update if you are already a current client, because tax laws are changing, have changed, and will likely continue to change into and throughout the future. So you got to stay on top of this on an annual basis. And that is certainly an additional component and part and value of the game plan for retirement planning process there at McIntire Retirement Services. But no cost, no obligation. If you'd like to get started in those conversations, pick up the phone, give a call, 800-868-1194. That is 800-868-1194, 800-868-1194. And Chris, really for the better part of a generation, since the early 80s, the American public by and large has been saving under the premise that taxes will be lower into the future. And I would say for the most part, that belief has held true, and we have been right in that line of thinking. But there's nothing that says that that is going to continue, nor is it written in the tax code or anywhere that retirees automatically pay less in taxes, correct?
That is correct. The income is typically lower for most folks. And then like for today's retirees, yeah, the tax rates have also come down. But in 2026, the tax cuts that were put in place by the Trump administration are set to expire. So taxes are going to go up. If they aren't made permanent, or not permanent, but if they aren't extended for another 10 years, no tax rates are made permanent. They have a 10-year segment to them. And if you look back at like in the 1980s and whatnot, how high taxes were compared to where they are now, they certainly could go up. I mean, look at, we talk about this, I mean, for my whole career, when I ask people at one of the educational events that we host is, look, do you think taxes are going to go up in the future or down? And everybody raises their hand. They think taxes are going to go up in the future because they think they need to pay down the deficit. And that's what governments do, raise taxes to increase revenue. And then, so if that's the case, then why do people keep putting money blindly into 401ks? They're going to be taxed at an unknown amount that they all think is going to be higher.
Right. Yeah. You didn't finish that thought that they raise taxes to build revenue. It would be nice if they would actually chip away at the deficit and debt with that, Chris, but the responsibility on that side of the table doesn't seem to be making that a very high priority. We're even having these debt ceiling debates, which I know has been an issue that when we've kind of reached this point has been a little problematic for the market as well, right? There's debate in Congress of can they keep and continue spending, and then the market sort of reacts to that, which I think that maybe if this debate rages on too much longer, we see some of that. What do you think? Is Congress going to get their act together on this and come to a kumbaya moment, or is this going to be a real sticking point?
Boy, if I was a betting guy, I would say they're probably going to get less done than more done, because that's what a divided Congress does right now. And, God forbid they actually cut some spending, which they won't. And, I get a little bit passionate here. They want to raise taxes, not cut spending. So why don't you cut spending and cut taxes? It puts more money back in people's pockets that they earn, and they get to do what they want with, instead of funding some other, the inefficient government program. And get me started on here. I'll start using. You'll go.
I know. I'm poking a little bit, Chris, because I know you'll go at it. But you, I think, are a fan and advocate of fiscal responsibility, which I think we've seen a lack of. And when we talk about taxes, we have to talk about the other side of it. What are they doing with our tax money? And I think that is the sticking point. I think that most people wouldn't mind paying taxes if they felt their money was being used responsibly. But because there are some decisions outside of what we view as being in that scope of responsibility, maybe we have a little harder time paying taxes and therefore want to be efficient. And there's a very famous judge, perhaps the most famous never to make the Supreme Court, Judge Learned Hand, who we have a quote here, Chris. It is no man's moral or ethical responsibility to pay more than their legal responsibility in taxes. And so we use what opportunities we can to be as efficient and effective as possible, but we also have to keep up to date, Chris. And there have been some changes in laws here that even if we had a plan in place last year or the year before, because of these law changes, we now need to revisit and update that plan.
Yeah, no question about it. And, with IRAs, when people pass away, they now have to be distributed within a 10-year time frame. They can no longer be stretched out, over the life expectancy of the non-spouse beneficiary, to be specific. Husbands and wives don't have those types of issues, but non-spouse beneficiaries do. And, so if you think about it, it's like, all right, nowadays seeing a $700,000 to $1.5 million 401k between a husband and wife is every day. And, that's a significant amount of money. And if they both are, taken out in a car accident, now all of a sudden we've got a beneficiary. It's got to take a lot of money out every year and drain the account over a 10-year time frame, instead of putting it off for later into retirement, that type of thing. They're forced to make those distributions. That was a big change, and we call that's part of the Secure Act. And that's had some other updates here as time has gone on. It bumped the required minimum distribution now is age 73, not 70 and a half, not 72. It will eventually get to age 75, but we don't have to worry about that for like 10 years.
Chris, just because we can wait a little longer, does that mean that we necessarily should? I mean, you spoke about when you ask your classes of retirees and pre-retirees their perspective, the answer and the general opinion is that taxes could be going up, are likely to be going up. So does that make now a great opportunity to start doing some proactive planning, especially if we do have a larger tax deferred balance in retirement accounts?
Yeah, you should be doing tax planning all the time. I mean, now they're bumping out when you have to take those RMDs out, so you have more time for Roth conversions and other tax strategies that you want to utilize. You can still do your qualified charitable distributions paid out to charities. Those things are still, a very viable option. But when we deal with folks that have significant IRA dollars, they certainly have more skin in the game. If it's somebody that retired with a middle income type IRA plan, is tax planning number one for them. If they've got a $500,000 IRA and 6 beneficiaries, and that's not a huge taxable event to spend that money out over a 10-year time frame. If it's $1 million IRA and we got 1 beneficiary, that's where we want to look at the Roth conversions, and what do they specifically need the money for? And, here on the radio show, I try to talk 2 different scenarios so everybody can kind of get some sort of feel for where they're at. Obviously, these are things that are very specific to the individual, Peter. And, that's why we need to have a sit down discussion and talk about what your tax planning strategy is. And, if you're paying somebody a fee to manage the money and you don't have any sort of tax strategy in place, is that what you're really, what are you paying the fee for?
Right. And what else could you be missing that is important in that conversation? I think that if the ultimate tax implications of the financial pieces that you have in place are not being discussed, that's a pretty strong indicator that there's an important part of the conversation that is missing. And it's about the implications long term. It's not just about, where you placed your money or the rate of return last year, but what ultimately is going to happen into the future. That's what true proactive comprehensive planning is all about. And if you'd like your no cost, no obligation written plan, that game plan for retirement, pick up the phone and give Chris McIntire a call. 800-868-1194. That's 800-868-1194. 800-868-1194. In fact, Chris, some of those long-term implications that aren't being discussed, I don't think really widely talked about, are the potential kind of double and triple whammies of tax deferral in those retirement accounts. As we grow the account value, also the IRS benefits, the tax bill and the dollars they will collect grows with that. That's kind of whammy number one. But there are some additional implications on our Social Security and Medicare that a lot of people are not fully aware of. Can you explain a little bit?
Sure, Peter. When it comes to like your Medicare premiums, for example, what you pay is dictated by the income that you bring in. If you have, if you bought a $250,000 condominium out of your IRA, your Medicare premiums are going to jump pretty significantly in all likelihood. There's the standard Medicare premium deduction, call it $168, $170 a month for most retirees when they start, and that can be dictated by how much income that they have as they go through their retirement.
So even that one-time kind of larger purchase, if we withdraw that from our IRA dollars, Chris, could have impacts on our Medicare premiums. And then Social Security by itself may not be taxable, but those other income streams, especially from tax deferred accounts, Chris, might go into an equation that causes our Social Security to also be taxable in retirement.
Yeah, and more people these days pay income tax on their Social Security benefit, and you can pay tax on up to 85% of it. So if you get $30,000 a year, you're basically going to pay tax on, call it $27,000 of that, income tax on $27,000. If you're in the 20% income tax bracket, that's $5,400 in taxes that you're going to pay on what they took out of your paycheck to pay you in retirement. So it doesn't seem fair at all. So there are a number of different tax loopholes here, or even potholes, if you will, right? You need to know the loopholes to avoid the potholes, probably the analogy I was looking for.
Well, again, we are talking with Chris McIntire. You need to understand not only the benefits of making a contribution or making an investment deposit and what the year-over-year tax implications are going to be, but looking forward, a forward-looking, proactive approach to controlling your lifetime tax liability, because in those tax-deferred accounts, the IRS is essentially your business partner, and we may have kind of a red zone window of opportunity here to buy them out while taxes are on sale. And so those are some of the strategies that Chris McIntire helps his clients to identify. If you'd like that written game plan for retirement, no cost, no obligation, a forward-looking tax approach included as part of that planning process, give a call, 800-868-1194. That's 800-868-1194. Now, we are kind of getting down to crunch time, Chris, but there are some strategic opportunities maybe to do a little bit from last year still available in certain circumstances. We can still make a couple contributions to a few accounts here and there.
Sure. Yeah. For those of you that have HSA accounts, you can still make those contributions up until the tax filing deadline. Your IRA, your Roth IRA contributions can also be made for the up until the tax deadline this year that have an impact on last year's taxes. So HSAs, Roth IRAs, and traditional IRA contributions. And many of you don't know that, even if your spouse isn't working, you may be able to make a contribution for the spouse off of your income. So spousal IRA contributions as well. And, I always say this, don't wait until April 14th to write the check. You want to try and get on these things as early as possible. So, put yourself in the realm of a CPA right now who are jammed busy between now and April the 15th, if you will. And, it's just a lot of pressure that goes on them with the way our tax system is set up in the filing and all that. So, sometimes you need to be patient here, but you want to make sure that the letter on that envelope is before April 15th.
Well, taxes are a pain, I think a thorn in all of our side as we have to get ready to prepare and file those taxes. But there are some opportunities, ladies and gentlemen, and for your financial progress, your comprehensive planning, you need to be looking at the tax strategies that are most opportunistic and will help you to be as efficient as possible with your money. Once again, being efficient with taxes, oftentimes just as effective as shooting for higher returns, but with far less risk. So let's identify those opportunities. Chris, a self-proclaimed tax geek, will help you do just that as he helps you design your game plan for retirement. Pick up the phone, give him a call. No cost, no obligation to get that plan put together. 800-868-1194. That's 800-868-1194. Specifically, if you'd like to learn how to retire or want to learn how to pay less in taxes, keep more of your money, call Chris McIntire and get your game plan for retirement. 800-868-1194. That's 800-868-1194. Chris, always a pleasure. Glad to have you along on the program each and every week to help us understand and identify what is important for us to be addressing in our planning progress.
Yeah, my pleasure. Good to be with everybody. Stay safe, and thank you for listening today.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.